Why trade one company when you can trade 50 with the click of one button? That's the power of indices. It opens up opportunities to trade a large volume of companies and sectors across the world. For example, the S&P 500 and many more. I will be diving into the A's to Z's of indices and explaining how it could be something you are missing out on. So stick around as we cover everything you need to know about trading indices. So you're probably wondering, what exactly is an index? In a nutshell, it's something which tracks the performance of a group of assets from an exchange such as the New York Stock Exchange, London Stock Exchange, and the Hong Kong Stock Exchange, to name a few. They are created by combining all the value of the shares into one aggregate value. This means that you could get exposure to an entire sector all at once while only having to open a single position. Imagine that. To recap, a stock index is commonly used by investors to evaluate the performance of their portfolio. Examples of stock indices include the FTSE 100, Dow Jones Industrial Average, Nasdaq Euro Stock 50, CAC 40, and the list goes on. To break things down further, the S&P 500 is the top 500 stocks in the United States. The Dow Jones Industrial Average is the top 30 stocks in the United States. So now you're probably asking, how do you trade multiple companies or sectors in any one given trade? Well, like most of our products, it's a contract for difference, a CFD, simply meaning you trade the contract and you do not own the underlying asset. Don't worry, I've added a link on CFDs in the description of this video below. Now, I'm going to discuss how indices could help your trading, even if you're not trading indices, because everything is interconnected. Knowing how they work is a valuable tool in every trader's toolbox. For example, the S&P 500 and dollar are good examples of this. When the S&P 500 goes up, the dollar goes down, and vice versa. So if you know what one of these assets are doing, you can pretty much work out what the other will do, which could be an advantage, especially when you need to make quick decisions on the trading floor. Every pro trader needs to know this correlation between their different asset classes. There are a number of factors that impact indices, such as number one, economic news. This could be reports from major economies, central bank announcements, speeches from financial heavyweights, geopolitical developments, among many other factors that can spark volatility. Company announcements. Ever heard of earnings season? This is a period where companies announce their profit and losses, which could cause even more volatility in stock prices. This in turn may affect the index's price. Commodity prices. Some shares listed on the index could be heavily influenced by commodity prices, especially if they're commodity related. So let me break down the key advantages of why you should be trading indices. I think firstly, you get immediate exposure to the entire index. So instead of trading that one company, you have the big boys under your fingertips. Number two, you can buy or sell because it's a contract for difference. Number three, you can trade with leverage. And number four, you can also hedge existing positions. You now have the full details. Will you take a deep dive into the wonderful world of indices? If so, which indices would you take a look at? Would you consider something that is not from the US, like the Indian Nifty 50? Lots to think about. Let us know in the comment section below. Remember to like, share, and ring the bell. Until next time, guys, thank you.